Fixed deposits explained 2026. Fixed deposits used to be the safest path to savings. Our parents trusted them. Banks promoted them. But in 2026, with inflation rising, interest rates shifting, and recession fears everywhere, the big question is, are fixed deposits still safe, or are they quietly losing your money? A fixed deposit, or FD, is simple. You give the bank a sum of money, they lock it away for a set period, and in return they pay you interest. When the term is over, you get your money back with a guaranteed return. It's one of the easiest, most disciplined forms of saving you can find. But in today's world, easy doesn't always mean profitable. Let's do a reality check for 2026. The financial world has changed. Inflation isn't a small number anymore. The cost of groceries, rent, and healthcare is climbing. Central banks are adjusting policies faster than ever, and the threat of recession is making everyone nervous about their cash flow. So the real question isn't just about the FD interest rate, it's about whether that interest rate can actually beat inflation. Here's where it gets interesting. Imagine your FD gives you a 7% return. Sounds pretty good, right? But if inflation is running at 6.5%, your real return, the actual increase in your purchasing power, is only 0.5%. And if inflation jumps higher than your FD rate, your money grows on paper, but it shrinks in what it can actually buy. That's the silent trap of FDS. Your savings look bigger, but your lifestyle gets smaller. So, who should still be using FDS in 2026? Despite the inflation challenge, they are extremely valuable for certain people. If you're a retiree who needs predictable income without the roller coaster of the stock market, FDS are a great fit. They're also perfect for low-risk savers who prioritize protecting their capital over chasing high returns. And for short-term goals like a wedding, a down payment, or just building an emergency fund, FDs offer the stability and security you need. They provide psychological peace of mind, and that has real value. In an uncertain economy, liquidity is leverage. Having access to cash when markets are down or layoffs are rising can be a lifesaver. FDs can provide that, but you have to choose the right type. A regular FD, a tax-saving one that's locked for years, or a more flexible sweep-in FD, all have different rules. Understanding these differences is key to making your money work for you, not against you. One thing that often gets overlooked is tax. The interest you earn from an FD is taxable. So if you're in a higher income bracket, a 7% return could easily drop to 5% or even lower after taxes. You have to look at the post-tax return to understand what you're really earning. So, how do you build a smart financial strategy in 2026? You don't abandon FDs, you position them strategically. Use them for stability, for your emergency fund, and for your short-term goals. But for long-term growth and to beat inflation, you need to look at other assets like mutual funds or real estate. The trick is not to depend entirely on FDS, but not to ignore their power for providing a solid, safe foundation for your wealth. So, the final verdict. Fixed deposits are not outdated, but they aren't a magic solution either. They are a tool. In 2026, the winning formula is to use FDS to protect your base, then take calculated risks with other investments to grow your wealth. It's all about balance. If you want me to break down FDs versus other investments like bonds or gold in more detail, drop a comment below and I'll cover it in my next video. Thanks for watching, and don't forget to like, share and subscribe for more smart money tips.